One of our next guests says the Fed has no reason to hike. The other says they have no reason to cut either. But both say that the best way to position is in this higher for longer scenario is to look for quality. Joining us now, Julie Beal, portfolio manager and senior research analyst at KAR, and Brian Jacobsen, Annex Wealth chief economist. Julie, why are rate cuts not realistic? You heard Steve basically say exactly that.
Well, if you look at the entire history of the Fed, they have only cut rates 6 times when employment was below 4%, and 5 of them were under Jay Powell. The last time before that was when interest rates were, the Fed funds rate was at 6%. So it's highly unlikely and, really difficult to justify rate cuts, particularly when you think about where rates are right now, right? It's not like we're at some astronomical level. We're about 60 basis point over the long run average for the Fed funds rate. And so there's more downside for the Fed in cutting rates too early than there is upside. And I think they've made it really clear that they want to see everything looking better, labor, housing, shelter, all of that, before they're going to even consider cutting rates.
I take your point that rates are not, by historical standards, high, but some rates are high. I mean, you look at mortgage rates above 7%. They haven't been this high in 20 years, Julie.
I still think that people are thinking of the last 10, 11, 12 years as, standard. And it's just not. It's a complete anomaly to be at, 0% interest rates for this long. And I think, a lot of money managers are younger and they don't really remember that rates can be significantly higher. And if you think about, upside, downside, it really just makes more sense that we would get down to a place that's more like 2 to 3% than 0. And so I think that limits the, the upside potential.
Brian, let's talk about the case for hiking. There is some indication that there's going to be at least one more hike. You say there's really no reason to do that either. So why are we paying these Fed guys anyway? If they're not going to do anything, let's not pay them, right?
Yeah. So, it doesn't really seem like there's a good reason to hike. Maybe they should just hold. And in fact, maybe the longer that they hold, that can almost be like a substitute for a hike. So they can kind of switch for their rhetoric towards, instead of how high, about how long. If you look at where we are with real yields and break evens, we're basically where we were in the 2004 to 2006 period. And I'm actually kind of curious if Chair Powell, if he's going to channel his inner Jim Bullard here. Coming out of the global financial crisis when rates were pegged at 0, Bullard made the argument saying that it's 0%, but the economy's fine, so why do anything? Just keep it at 0. Well, now, if you've got the Fed funds rate at 5.5, we're cruising along, things look good, why mess up a good thing? So perhaps his argument is going to be that things look fine for now, and so why really mess with something that looks good, at least so far.
So if we're looking, Julie, at this higher, and I saw you nodding there as Brian was talking, if we're looking at a kind of a static or a stasis state in interest rates, and we say higher for longer, how much longer is longer?
Well, I think we all understand that, getting from 10 to 5% inflation was pretty easy, but getting us down to 2% is probably going to be harder. And I think the language out of the Fed has been really all over the place as far as, is it 2% or is it 2.5%? And it really actually does make a difference because you start to get these base effects coming into the data. The other thing is I don't really think that we're going to get to this place where, inflation kisses 2% and the Fed is like guns blazing, cut rates. I really do think they're going to want to see some consistency and some holding before they start to cut.